Hello, 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 and happy Thursday, and welcome back to yet another live event where we unpack passive investing, risk management, due diligence, underwriting, one step at a time. So, why a property can have a 125 times debt service coverage and still miss the mortgage payment? That's the topic we'll cover today. But before we dive in, for those who are tuning in for the first time or haven't yet met me, my name is Vessi Kapulian, a former commercial lender handling a pretty sizable, north of $1 billion credit portfolio. Commercial lender turned real estate investor, entrepreneur, due diligence advisor. Today, I spend most of my time really in two capacities: advising and investing. On the advising side, I work with family offices and their family enterprises at the board level. And on the investing side, very selectively invest in apartments. I also work with private investors and consult private investors who may need a second set of eyes on the investment offering, a structure, numbers, a due diligence process. And for those willing to do a deeper dive, I also have a small community where we interact and I help them learn how to underwrite a deal from beginning to end so they can confidently vet those investment opportunities and minimize the risk of loss. And last but not least, last year slash early this year, I published Mastering Multifamily Underwriting, which is now available on Amazon. And there I discuss in greater detail vetting the numbers of an apartment deal. So, without further ado, let's get back to today's topic. So, you may have looked at a deal, looked at the DSCR, and oftentimes you'll hear it needs to be at least 125 times or higher. So, you look at that number and you think, well, the loan should be safe, right? I am here today to tell you not necessarily. As always, we have to peel the onion to its core, even if it makes us cry. So, one of the most dangerous mistakes that I often see in portfolio monitoring is assuming that debt service coverage equals debt payment safety. And I can tell you from years of experience, both on the lending side and the investing side, that this is not necessarily the case. The property may be in compliance with that 125 times debt service coverage covenant, but still fall into actual payment default. And on the surface, that may sound contradictory, but it actually happens more often than people realize. So, today I want to walk you through why that may be the case, break down why the concept of why debt service coverage only tells part of the story, and help you unpack or understand what truly determines whether debt gets paid or not. So let's first start with the definition, start with the basics, and then we'll work our way up. So, debt service coverage is simply net operating income divided by debt service. And that right off the bat tells you that it answers one very specific, one very narrow question, namely, does the property generate sufficient net income from operations to cover the scheduled principal and interest? So, that is, of course, important to know. That is useful. That is how a lot of loan, actually, most loan agreements, when it comes to term debt and real estate, are structured. But notice that there are few key items missing, right? The NOI does not necessarily account for other items impacting cash flow, such as the capital expenditures, tenant improvements, major deferred maintenance, any working capital swings, any escrow and other reserve requirements, timing mismatches, and any short term liquidity drains. In other words, it doesn't capture free cash flow. So, yes, a property may have positive NOI or large enough NOI to satisfy the debt service coverage test, but it does not automatically mean that it generates sufficient cash flow and or that it has sufficient liquidity to make the next mortgage payment. And so uh, that distinction is key. So let's just start with free cash flow. I mentioned two things: free cash flow and liquidity. So let's start with free cash flow. And what is free cash flow in a more practical formula based approach, right? That's your NOI less debt service, less any recurring maintenance or rehab related capital expenditures, less any working capital needs, or plus or minus, right? Working capital needs, and then any distributions. So that's really your free cash flow after operating, financing, and investing activities. And that's where many deals may break, because that debt service cover wouldn't necessarily capture any major HVAC replacements that have come up, maybe unexpectedly, any heavy turn costs, higher true ups, tax resets, and whatnot, which can quickly turn that cash flow from positive to negative. So while the income statement may look acceptable, the cash flow statement tells a very different story. And that is why a few LinkedIn pop up live events ago, I actually had a whole event focusing on the importance of not only understanding the cash flow statement, but also the importance of cash flow forecasting and cash flow tracking, ideally on a daily basis, but if not daily, at least weekly or monthly, it should be done. Earlier in today's pop-up live, I also mentioned liquidity. So those reserves and escrows matter more than people realize. And so um, when it comes to capex, oftentimes these are earmarked upfront at the beginning of the deal, right? That capital is raised for upfront. There are also certain escrows put into place to account for any tax, insurance, and in some cases even debt service. But if those reserves are not in place from the beginning, or if they have been depleted due to ongoing leakage or ongoing negative cash flow, then the property is really relying on operating cash flow to absorb these shocks. So that can very quickly wipe out existing reserves, especially if that operating cash flow is not present. So yes, the covenant may still be in compliance, and you may be drawing from existing reserves to uh, pay the debt in the meantime. But when you run out of money, that's when the real issues surface, and potentially, right, default may occur. And so um, it's important to really understand not only what NOI is generated, but how much is the free cash flow, and how much of that free cash flow is being retained. And that's why that cash flow forecasting exercise, or really process, I don't want to exercise is probably not the right word. I'll say process, because it really needs to be institutionalized and part of the daily processes for the asset management teams and finance teams. And it's digging into the sources and uses of cash, operating cash flow, existing reserves, sponsor support, if there are capital calls, any additional access to credit, asset sales. These are all sources of cash. And then tally that against the uses of cash, which would be the debt service, capex, operating expenses, taxes, payroll, all of that. And when those uses, right, start to exceed the sources, that adversely impacts cash flow. And in that case, it's important to figure out, well, what is, if I've been operating with negative cash flow for a prolonged period of time, what does that cash burn rate look like? In other words, at the current negative cash flow run rate, how many months of liquidity remain? What is the point at which I will run out of money? And the next step there is to think through, okay, if that's the case, what other sources of liquidity do I have access to? So that final layer of thinking through the cash flow exercise, the liquidity exercise, the cash burn rate is access to external liquidity. Because if with that access, the payment default can still be avoided, right? And some may come from the sponsor's personal balance sheet strength. They may have access to, either at the corporate level or personal level, to lines of credit or other liquidity facilities. Maybe other capital partners can step in, either on a more permanent or temporary basis. We're seeing a lot of preferred equity tranches coming to deals these days. So sophisticated risk management, it's not just about the asset itself, but about the entire liquidity ecosystem, if you will, around it. And that's, especially in today's environment, that's particularly important. So a big takeaway is, like I said at the very beginning, peel the onion to its core, even if it sometimes may make you cry. But a 125 times debt service cover does not necessarily guarantee debt payment safety or debt payment capacity, because NOI really captures only part of the story. It doesn't capture liquidity on hand, and doesn't capture free cash flow after capex and working capital needs. It does not capture reserve sufficiency and burn rate. Neither does it capture sponsors support capacity. And that's exactly why you may read in the paper, right, that a property was in covenant compliance or had debt service cover over 1 times, but it still entered into payment default, and the lender ended up taking the property. So for investors, active or passive, family offices, that's why I always emphasize the importance of cash flow monitoring and forecasting, liquidity analysis. They're just as important as underwriting a deal on the front end. And so if you are reviewing a deal and want a second set of eyes on true cash flow risk, feel free to connect with me one on one. And do me a favor, I know many of you tend to catch the recordings of these live events. So put in the comments, have you ever seen a deal with acceptable debt service coverage but weak liquidity underneath the surface? Would love to hear your perspective, your direct experience, and we can all learn from one another. Of course, you're always welcome to put questions in the chat as well and connect with me one on one. I like doing these live events once a week, usually on a Thursday or Friday afternoon, where I share different nuances of due diligence, underwriting, passive investing, or market updates that I find interesting and want to offer an additional perspective on. So, with that, I wish you a wonderful day, and don't forget to subscribe to my YouTube channel as well as LinkedIn, so you get notified of future pop-up lives. I wish you a beautiful rest of the day and a beautiful weekend. Ciao.